So the revised exposure draft for insurance contracts brought some significant changes from the previous exposure draft and has received some very vocal responses from a number of key players in the Canadian insurance industry. In this short video, I'll be covering an overview of the comment letter responses to the IASB from both a Canadian and an international perspective. The comment period for the revised exposure draft on insurance contracts closed on October 25th, and there have been over 200 comment letters issued in response to the 5 key targeted areas of change. The IASB also sought input on how the exposure draft has balanced the costs and the benefits when developing those proposed changes, given that these changes may increase the complexity of the model. This slide summarises the overall responses to the IASB's targeted questions, and we can see that for the most part, Canadian responses were relatively consistent with the international responses. Canadian insurers were largely in agreement with the contractual service margin principle and the concept of unlocking this margin. However, many respondents believe that the risk adjustment should also be treated in the same manner to be consistent. There was widespread disagreement both in Canada and internationally with respect to the application of the mirroring rules, which would be relevant to certain participating policies. Some Canadian respondents consider the approach to be too narrow in its proposed application, as well as there being a practical implication for how to decompose a policy's cash flows to fit the proposed accounting model. Many respondents are in support of the earned revenue presentation for the simplified short duration approach, mostly the P&C insurers. However, many disagree with using the proposed new revenue approach for long duration products, mostly the life insurers. Respondents in Canada wanted to keep gross premiums written on the income statement and raised concerns about the cost of the new revenue approach outweighing the benefits, as well as resulting in fundamental changes to KPIs used to assess companies' results. Some respondents believe this will result in multiple reporting formats needed to meet management, statutory, and external reporting requirements. Many life insurance companies are concerned with determining the long-term discount rates, where there are few or no observable market interest rates, particularly with respect to the perceived impact on volatility and on capital. Some respondents have requested more clarity with respect to the use of management judgment when determining these long-term rates. There was broad acceptance over the use of OCI to present changes in discount rates. However, many have raised concern over the fact that this is mandatory. Canadian and international organisations are urging the IASB to make this method optional. This is seen as an area of significant operational complexity in tracking different discount rates and could result in further accounting mismatches if the assets backing the liabilities are at fair value through the profit and loss account. In terms of transition, many Canadian organisations have actually requested a longer implementation period because of the complexity, whereas international organisations appear to be comfortable with 3 years. Both Canadian and international insurers also want to change to the proposed standard that gives them the ability to adopt IFRS 9 and IFRS 4 at the same time, so they can better align the decisions made when designating financial assets. We will wait and see how the IASB listens and responds to the feedback provided as they work towards issuing a final standard in 2014 or in early 2015. If you have any questions or would like to speak to someone about the impacts of the new insurance accounting standard for your organisation, we would love to hear from you. Thank you.